Will the Reserve Bank of India do its much-awaited sale of bonds, or what is called OMOs, in the first week of November? That's the narrow question that we are asking today. More broadly, how will an OMO announcement be received by the bond markets? Will yields rise? How much will the Reserve Bank suck out from the market? And finally, given the global backdrop, should we see a continued rise in Indian yields as well and in the cost of capital? Or is the worst over for Indian corporates and consumers? To answer these, I have with me Samiran Chakrabarty, the Chief Economist, Citi Bank in India, and Abhishek Upadhyay, the Senior Economist with ICICI PD. Gentlemen, thank you very much for your time. Samiran, to you first. The Reserve Bank has kept the one-day money, the call rate at 6.75 rather than at 6.5. Now, do you think the circumstances continue to warrant this? In the sense, are there still inflation fears like, onion prices or asset prices getting frothy?
Thanks, Latha, for having me on the show. I think there are at least three different issues that RBI is grappling with right now on the liquidity front. The first is obviously, as you mentioned, that inflation is still higher than the 4% mark. Yes, it has come down to 5% in the last reading, but not so far back. This was much higher than even the 6% upper tolerance band. The second issue is that global yields have moved up significantly. So is there an argument for Indian yields to also, to some extent, match up with those global yields, and to that extent reduce any pressure on currency depreciation? And the third issue is with respect to financial stability in general, where this so-called excess liquidity condition is creating different kinds of froth in asset markets, not just in the more obvious equity, real estate, but it's also in areas like retail credit. It's there in bond spreads, corporate bond spreads. If you look at in the first half, they have been relatively more benign because of this liquidity. And all this is resulting in the overall financial conditions being much easy now compared to what it was when RBI first started hiking rates. So these three considerations, the yield consideration, the inflation consideration, and the financial stability consideration, I think that's what is forcing RBI to even talk about tightening liquidity at a time when friction liquidity is already quite tight.
Okay. Would you agree, Abhishek? In fact, in Samiran's paper, Samiran, you're even talking about financial stability amid some signs of froth. You think the Reserve Bank would be legitimately worried, or, that Nifty is one of the better performing indexes, growth is steaming in several parameters. So is it a legit worry that they are going to continue to keep the yield at 6.75 overnight yield for the foreseeable future, maybe for all of this 2 quarters?
This for me, Latha?
Yes, Abhishek.
Yeah, so broadly, I agree that overnight rates hovering between repo and NSF corridor is consistent with the current stance of monetary policy. And RBI will be happy if overnight rates are in this corridor rather than in the SDF and repo rate corridor. Also, what we should know here is that, the earlier rate hike cycles, we know repo rates peaked at much higher levels than the current cycle. So 6.5% repo rate is quite low in that context. And that also likely provides RBI that extra bit of flexibility to keep rates, overnight rates slightly higher rather than lower. It adds to that motivation. And lastly, it is possible that RBI has some financial stability considerations in mind. We know that credit growth has been very strong, particularly the retail. Personal loan growth has been very strong.
That's right.
It is possible that those considerations are also leading RBI to not just look at the cost of liquidity, which has stayed high all through last 4-5 months, but even the level of liquidity that RBI therefore wants to continue to tighten.
Okay.
And that likely informed motivation to announce OMO sale, which was somewhat of a surprise for
Yeah.
bond market.
Yeah, it was a surprise that the incremental CRR was not continued, but in lieu of it, something even more hawkish, perhaps, like a OMO was announced. But Samiran, your report says that you are expecting the OMO in November. In fact, many people in the market told me that. Why? And how much?
So RBI, Latha, there are two different questions here. One is how much, and the other is timing. And the two answers to these two questions are determined by two different things.
Okay.
So the answer
Okay, first
to the
timing
question
then.
on,
First timing then.
So the first timing question, let me pose the questions in a reverse order
Okay.
and first answer the quantum and then the timing.
Sure.
So the quantum is a function of the durable liquidity in the system. In the past, the RBI has mentioned that about 1.5% of NDTL is a non-inflationary threshold of liquidity. That technically puts liquidity threshold at around 3 lakh crores.
Yes.
But we are lower than that. But because of the things that we discussed earlier, RBI might be thinking now of a lower non-inflationary threshold of durable liquidity. So our sense is that RBI would probably want to reduce durable liquidity by about 50,000 crores.
Okay.
That is assuming that there will be some inflow of liquidity through bond index inclusion by Q4 of this fiscal year. Now, out of this 50,000 crore, that is the quantum of liquidity that they want to reduce, the timing will be governed more by the frictional liquidity in the system. They can't tighten the system when it is already tight. And there we are looking at November because in the first week of November, there is redemption of about 54,000 crore. And in the last week of November, there is again another redemption of close to 90,000 crores. These two periods, the redemption means the government will be pumping in money into the system. And we think that banking system liquidity might turn surplus on these 2 points. If that happens, then RBI gets a window in the beginning of the month and at the end of the month to do something like 15,000, 25,000 crores of OMO sales in these two pockets. And that would satisfy the overall 50,000 crore liquidity drain that they would want from the durable liquidity perspective.
Okay, now Abhishek, if that's somewhat similar to what I heard from the market as well, that some 53,000 crores is coming this week, and then by end of the month another tranche of 50,000, 30,000 is coming. So, if they were to announce OMO this week or next week, will that push the yields even higher? How will the market react?
Well, so what you saw was on the policy day, yields sold off or yields rallied quite a bit, but then market has stabilized at those levels, even as global financial conditions remain tight. I think particularly if you're looking at reaction to OMO, it will depend on what size and what tenors. So assuming that the auction size is anywhere between 10 to 15,000 crores, I think that is broadly the pace that is already baked into the markets. But if the pace is higher and markets worry, therefore, that both the overall quantum of OMO sale can be higher because of that higher auction size, or the pace could be quicker, then that could have some negative impact.
Okay.
Our own assumption is that RBI will want to tread carefully. We know that use of OMO sale can be self-limiting because of disproportionate impact on bond market sentiment, given very high general government borrowing requirements that we typically have. So a smaller, a more steady pace would likely be better. But yeah, what will also matter is the headline liquidity. If government surplus really comes down quickly, and last year government surplus was high same period last year, but came down very quickly, more than by more than 2 trillion in November and early December. So if we get that pace, it is possible they may want to do something like 25 to 30,000 crores.
Okay.
But the risk right now seems to be that it will be two OMOs with 10 to 15,000 crore.
Okay. No. I just want very quickly the yield reaction to it. You think it will remain at 6.75 or and the 10-year at 7.35, or do you think there is a chance they go higher? Or they go lower because they are relieved?
It is possible yields can come down a bit if the pace is only 10,000 crores. But obviously, global conditions will matter.
Yeah.
And we don't expect any imminent easing quickly on that front. So the downside is also capped in that
Fair enough. Samiran, exactly that to you. What is since you are from a global bank, what's the base case at Citi itself? Are they expecting yields to continue to remain high? So will the global impulses of high oil prices and high yields continue to be the backdrop for the next quarter or two?
I mean, in today's world, Latha, quarter or two is a very long period.
Okay.
We are having very sharp moves almost on a daily basis. But the fact is that I think the key component from Indian bond market perspective would be that whether there is any certainty on this OMO sales or not. The problem with the October announcement to some extent was that it was very open-ended. So that created more panic in the market and the sell-off was quite acute. But if through the next month or so, there is some certainty around how much this OMO sales amount is going to be, we might actually see the markets having a bit of a relief and then getting prepared for the bond index inclusion related flows. For me, the bigger question is that, is this also a signal from the RBI that whenever the bond index inclusion related flows come, that will be absorbed and neutralized through OMO sales? So that kind of sterilization, is this a signal for that as well? If that happens, then the rally on bonds could also be very limited. But for the moment, it is the quantum and certainty of the OMO number which will be
crucial.
What the markets would be looking for.
Fair enough. I'm asking a question for which I want just a one sentence or even monosyllabic answer from both of you. Abhishek, you go first. Can corporate India, can NBFCs assume that the cost of capital for them will not rise here on? We are at the highest, say, for the next couple of quarters.
Well, liquidity will continue to tighten and rates will stay here. So, yeah, it is possible there will be some tightening in. And as monetary policy transmission takes place, there will be some tightening in cost.
A little more higher. Samiran, your thought?
I think I will agree with that perception, although policy rates might have peaked, but the transmission is still incomplete.
Okay, so that is some kind of a warning for corporate India. Thank you very much, Abhishek and Samiran, for giving us whatever clarity is possible about whether RBI will sell bonds, how much they will sell, and what impact it can have on yields. Thank you very much. That's it on It's the Economy. Time for a break. Chartbusters up next.